Welcome to the One More Bitcoin channel, and thanks for joining us today. We're kicking off this deep dive by strapping in really for a high-speed look at one of the most, let's say, controversial blockchain ecosystems out there right now, Solana.
That's right. It's the one people often call an Ethereum killer. Though the One More Money blog had a great description recently, calling it the supercar of crypto.
Ah, SuperCar. I like that. Fast, sleek, but maybe a bit temperamental.
Exactly. Promises incredible speed, really low costs, but yeah, that performance definitely comes with some, let's say, significant risks.
Okay, so let's unpack this then. Our mission here is to dissect maybe the 5 biggest truths about Solana, things that might even seem counterintuitive. We need to get into the engineering, how it gets that speed, what the trade-offs actually mean for you, the user, and how it's changed looking at it now in 2025. It really is a story of compromises.
Absolutely. And before we really dive into the nitty-gritty, the tech, the market stuff, just a quick reminder for everyone listening.
Yeah, it's the necessary bit.
Yeah. Everything we talk about today is just for informational purposes. We're looking at source material, analyzing it. This is definitely not financial advice. We'll give you the full disclaimer at the end of the deep dive.
Right. So, Solana, where do we even start? The One More Money blog used this metaphor. A fork in the road. That seems like a good place.
It really is. It captures the fundamental conflict. So imagine you're at this crossroads. On one side, the old road that's like Ethereum.
Okay, the established path.
Right. Sturdy, secure, but it's like a 2-lane highway during rush hour. Congested, slow, and tolls are high, those gas fees. Reliable, but costly and slow.
And the other path?
That's Solana, the brand new, super wide, 8-lane digital expressway. It's incredibly smooth. Transactions cost almost nothing, fractions of a cent.
Sounds amazing.
Yeah.
But what's the catch?
The catch is sometimes that superhighway just closes suddenly. No warning. And everyone's stranded. That's the tension right there.
Speed versus reliability.
Pretty much.
No.
And it all stems from this classic problem in blockchain design, the scalability trilemma.
Right, the balance between decentralization, security, and scalability. You can't easily max out all 3.
Exactly. Most older chains, like Bitcoin and Ethereum, they really prioritize decentralization and security, which is great, but it meant scalability became a huge bottleneck.
So Solana just picked a different priority.
They made a very conscious, almost radical choice. They looked at that trilemma and said, okay, we are going all in on scalability. The goal wasn't just to be faster than Ethereum. It was kind of unbelievably to handle the sort of transaction volume you see across the entire internet.
Wow, okay, that's ambitious.
Hugely ambitious. And that single engineering focus explains almost everything that followed, both the incredible successes and, frankly, the big failures.
Let's dig into that engineering obsession then. Starts with the founder, right? Anatoli Yakovenko.
Yeah, Anatoli. And his background is key here. He wasn't like a crypto theorist. He spent 13 years building high-performance systems at places like Qualcomm and Dropbox. He understood speed at an industrial scale.
So he comes into the crypto space around 2017 and sees what? A problem he thinks he can engineer his way out of.
Pretty much. He saw Bitcoin and Ethereum chugging along at, maybe 7 transactions per second? Sometimes 15 or 20 on a good day.
Glacial compared to traditional finance.
Totally glacial. Compare that to something like Visa, which needs to handle tens of thousands of transactions every second globally. Yakovenko knew blockchain had to get way, way faster to be anything more than a niche curiosity.
Okay, but how? Just throwing better hardware at it doesn't magically fix consensus delays in a distributed network, does it?
No, you're absolutely right. Faster computers help, but the real breakthrough was conceptual. It's this thing called proof of history, or PoH.
Proof of history. I've heard the term. It works with proof of stake.
Exactly. It's a hybrid. PoS handles the actual validation and security, but PoH is the secret sauce for speed. The One More Money blog had that great analogy calling PoH Solana's assembly line.
An assembly line. Okay, explain that. How does it work?
Well, think about older blockchains. A lot of time is wasted just by validators talking to each other, trying to agree on the exact order of transactions. Did you see transaction A before B? No, I saw B first. That back and forth creates latency.
Right, the consensus overhead.
Exactly. PoH gets rid of most of that. It acts like a verifiable, super fast, decentralized clock running constantly. It uses a cryptographic process, basically hashing output back into the input over and over to create a timestamp sequence.
So it puts a timestamp on transactions before they even get validated.
Precisely. It creates this historical record, this sequence of events that everyone can trust and verify almost instantly without needing lengthy debate.
Ah, I see. So the validators don't argue about the order anymore. They just check if the transaction fits correctly into the pre-established PoH sequence.
You got it. It massively cuts down that communication and agreement time. It streamlines the whole thing.
And the result is?
Wow.
What are the numbers?
The numbers are pretty wild. A theoretical peak of over 65,000 transactions per second, and average transaction fees that are consistently like less than a penny. That assembly line is why Solana can be that supercar.
Okay, 65,000 TPS, sub-penny fees. You'd think it was built for, like, high-frequency trading or global payment networks.
That's probably the intention, yeah.
But what actually took off, what became the kind of unexpected killer app?
Meme coins. It's almost funny, right? This incredibly sophisticated high-performance infrastructure, and its first major breakout use case was trading digital pictures of dogs and cats at lightning speed.
Things like BOINK, WIF, PopCat.
Exactly. BOIK, dog with hat, all those. For a while there, meme coin trading and maybe some NFTs absolutely dominated the network activity, often overshadowing the more complex DeFi applications.
But thinking about it, maybe it's not that surprising if you connect it back to the tech.
It actually makes perfect sense.
Right. Meme coins are all about speed, momentum, getting in and out quickly. If a transaction takes minutes to confirm or costs $50 in gas,
The hype dies instantly. The whole model breaks down. Solana's core features transactions confirming in under a second, basically zero fees. That's the perfect environment for that kind of high-velocity, viral speculative trading.
so platforms like Pump.Fun, they thrived there because the tech allowed that instant gratification, that immediate trade execution.
Absolutely. Solana became the default home for crypto's cultural velocity, you could say, purely because the tech enabled it.
But is that still the case now in 2025? Is it just the meme coin chain?
Well, that's what's interesting. The data suggests a shift is happening. Meme coins definitely brought the initial massive user wave, but now we're seeing more activity lean towards things like stable coins, more sophisticated DeFi protocols, institutional use cases maybe.
So the performance is starting to support a broader, maybe more serious ecosystem.
It seems that way. The foundation laid by that speed is now proving useful for more than just speculation, which is a sign of maturation, I think.
Okay, but we have to talk about the flip side, the dark side of that speed. The Achilles heel, really.
Reliability, yeah. This is Solana's biggest persistent problem. Those aggressive engineering choices that gave us 65,000 TPS, they also introduced instability.
And we're not just talking slow transactions sometimes, we're talking complete network shutdown.
Exactly. Full-blown outages where block production just stops, grinds to a halt. And that's incredibly damaging for user trust.
The One More Money blog mentions some specific big ones.
Oh yeah, September 2021 was a bad one. The network was down for about 17 hours straight.
17 hours? What caused that?
Basically, it got flooded with spam transactions from a bot launch, an IDO. The way validators were processing the queue, resources got exhausted, and it led to a cascading failure. The network just couldn't cope.
And it happened again more recently?
Yep. February 2024. Another outage, about 5 hours that time. That one was blamed on a bug in the validator software itself, which caused consensus to fail across the board.
If you're trying to be a global financial layer, how can you have the entire system just crash for hours, multiple times?
It's the price of pushing the limits, maybe. Like tuning a racing engine, it runs incredibly fast, but it's operating much closer to its breaking point. The tolerances are tighter, so when something unexpected happens, like that flood of spam, the whole system can seize up. And recovering a system that fast is complex.
So what have they done about it? They can't just let the highway keep closing down.
No, they put a ton of effort into fixing this. There's stuff like stake-weighted quality of service, or QoS, which tries to prioritize transactions from legitimate stakers over potential spam.
Okay, that helps with the spam issue.
Right. But maybe the biggest thing is the push for multiple validator clients. Historically, almost everyone ran the same core software. Now, there are independent alternatives being developed, most importantly, Firedancer from Jump Crypto.
Firedancer, I've heard that name. Why is having different software so important?
Because it drastically reduces the risk of a single bug taking down the entire network. If one client has a problem, validators running other clients can hopefully keep the network going. It builds resilience.
That makes sense. Redundancy. And has it worked?
Well, credit where it's due. They did mark a full year without a major consensus outage as of February 2025. That's a significant milestone.
Okay, a year is good, but does the average user still feel the strain sometimes, even if the whole network isn't down?
Oh, absolutely. That's the other persistent complaint. Even when Solana is technically up and running, during peak times, like a huge meme coin launch, users still experience a really high rate of failed transactions.
So your trade just doesn't go through.
Right, you click buy and nothing happens, or you get an error. For a regular person trying to make a trade, that's almost as frustrating as a full outage, and it's still a major user experience headache they need to solve.
Okay, so speed brought users, but also instability. What's the other big trade-off? You mentioned something more philosophical.
Centralization. Yeah, this one really cuts to the core of what blockchain is supposed to be about,
Yeah.
Decentralization, power to the people, no single point of control.
But Solana's design choices challenge that. How?
It boils down to the hardware needed to run a validator. To keep up with that proof of history clock and process 65,000 TPS, you need some serious computing power.
Like more than just a good gaming PC.
Oh yeah, way more. We're talking top-end CPUs, specialized setups, and the RAM requirements are insane. Often 256 gigabytes of RAM, sometimes more, plus really fast, high-end SSD storage.
Wait, 256 gigs of RAM just to validate blocks. That's data center level hardware.
Pretty much. It has to run that PoH hashing constantly and process the massive amount of transaction data generated and participate in consensus. It's incredibly resource intensive.
So the consequence is not many people can afford to do it.
Exactly. It creates a really high barrier to entry. Your average crypto enthusiast running a node from home, not really feasible on Solana. Instead, validation power naturally concentrates in the hands of those who can afford that hardware.
What do you mean?
Fewer, larger entities. Big institutional stakers, professional data center operations. They become the ones primarily securing the network.
Is there a way to actually measure that concentration?
There is. It's called the Nakamoto coefficient. It basically asks, what's the minimum number of independent entities you'd need to compromise to control over a third of the network's stake, enough to potentially halt or censor it?
And for Solana?
Well, Solana has a lot of nodes overall, over 4,500 globally, and maybe 1,400 actual consensus validators, which sounds good, but it's Nakamoto coefficient. It's consistently been cited in the low 20s, even into 2025.
Low 20s? Is that good or bad?
It's lower than many of its major competitors. A higher number means more decentralization. So a coefficient in the low 20s suggests that, yes, control is more concentrated than on some other chains.
So that's the ultimate philosophical trade-off, isn't it? To get that incredible speed and low cost, they sacrificed some degree of accessibility and decentralization and validation.
That's the core criticism. Is Solana becoming more like a really fast, slightly distributed database run by professionals rather than the ideal of a truly decentralized world computer?
It's a valid question. Okay, so let's try and synthesize all this. Connect the dots from our 2025 perspective. Solana is fast, cheap, but has had reliability issues and faces centralization questions.
That's pretty much it. It solved Ethereum's biggest user pain points, congestion, and fees, but created its own set of challenges in doing so. It's defined by those trade-offs.
And yet, despite those challenges, the financial world seems increasingly interested. We're hearing serious talk about spot SOL ETFs, right?
Definitely. Those discussions are gaining real traction with regulators, much like we saw with Bitcoin and Ethereum ETFs before. That signals a growing level of institutional comfort, or at least interest.
And that's driving some pretty bullish price predictions, too.
Yeah, you see analysts talking about Solana potentially hitting the $200 to $350 range in this cycle. That institutional validation is a powerful narrative.
But hang on, how does that square with the issues we just discussed? The outages, the centralization concerns. Why would big institutions be comfortable with that risk for something like an ETF?
That's a great question. I think part of the answer lies in those engineering fixes we mentioned earlier, particularly the multiple client approach with Firedancer, Agave, Jito.
The idea that redundancy makes it safer.
Exactly. Having different teams build independent software to run the network significantly lowers the risk of one bug causing a total meltdown. It doesn't fully solve the hardware centralization issue, perhaps, but it dramatically improves operational resilience. Institutions likely see the stability problems as being actively addressed or even mostly solved, making the speed and low fees too attractive to pass up.
So they think the worst of the outages might be behind them.
That seems to be the bet they're increasingly willing to make.
Okay, so back to the SuperCar analogy to wrap up.
It still fits perfectly, I think.
Yeah.
Solana is undeniably fast, a real feat of engineering. The user experience when it's working smoothly is fantastic, cheap, and instant. But it requires expert maintenance, maybe. Its high-performance design makes it inherently a bit more fragile, more volatile than the sturdy, slower sedans of the crypto world. So the fundamental question For anyone looking at Solana seriously, developers, investors, users, it remains the same. Are those huge gains in speed and cost worth the trade-offs? Worth the risk of occasional hiccups and a more concentrated validator set?
That's the calculation everyone has to make for themselves. Is the supercar worth the potential headaches?
Exactly. And that's the question that will likely define Solana's path forward.
A really interesting deep dive. Thank you, everyone, for sticking with us and engaging with this look into Solana. If you're interested in cryptocurrencies, DeFi, Bitcoin investment, all things crypto, really, make sure you subscribe to the One More Bitcoin channel. That way you won't miss any of our future deep dives and updates. And hey, give us a like if you found this useful, and definitely leave a comment below. Let us know what you think about Solana. Is it a buy for you, or are the risks still too high? We'd love to hear your take.
And just that final, mandatory reminder. This information was presented for educational and informational purposes only. It is absolutely not financial advice. Investing in cryptocurrencies involves significant risk. It's a very volatile market. Always do your own thorough research, consider your own risk tolerance, and consult with a qualified financial advisor before making any investment decisions. What we discussed reflects analysis of the source material, not a recommendation to buy or sell anything.
Couldn't have said it better myself. Thanks again for watching.
Goodbye for now.